Well, listed property has bounced back strongly this year to be among the JSE's best performing sectors. There are now fresh concerns with the renewed lockdown level 4 and the riots and looting, which haven't seen some large malls like Queensland spared, though it has been fairly isolated, and I say that advisedly at this stage when it comes to large malls. Is a reckoning in REIT land, and in particular retail REIT land, coming? Before the pandemic, we saw the excessive focus on income, perhaps without due regard to the sustainability of that income or the risks taken to generate it. And it's exactly what got the sector into trouble. You can't ignore that shareholders have been complicit in this too. They must take responsibility for what they hired boards and paid management teams to do, and we've got to look at incentives here. And we saw rising profits not necessarily reflecting good strategic decision making or the creation of long-term economic value. And that only occurs when companies invest in positive net present value strategies where the return on capital exceeds its cost. Now, every student of finance is taught this rule, and this business and investment theory has been ably demonstrated through this crisis that has exposed a pandemic of debt, none more so than in the listed property sector. And when faced with low growth here at home, we saw the executives at a number of South African REITs looking towards Central and Eastern Europe and the Antipodes for growth, and that raised foreign currency debt to fuel their expansion. And there is an issue now with lacking sufficient equity to absorb the losses from COVID-19 related shutdowns. We've seen debt to market value ratios risen dramatically. So what are the lessons in all of this? And what is the outlook for the listed property sector into the second half, which has bounced back remarkably well? Let's welcome our panel to kick the brick, so to speak. Malcolm Horn, CEO of Brol Property Group. Madeleine Sessions, who co-manages the Denker SCI Balance and Stable Funds with Jan Meintjes. And Andrew Brooking, Corporate Finance Executive and Founding Director of Java Capital, one of the top corporate finance houses specialising in property M&A. Madeleine, kick us off here. The property boards, the management team, shareholders, all forgot that they're actually responsible for own businesses, and that these businesses, as other businesses do, add value through an operating and a proper property strategy. And we saw this excessive focus on income without regard to the sustainability of that income. It's really what got the sector into trouble. Are you surprised at how quickly the sector has bounced back? What are the lessons as well that we need to take from the pandemic?
Sure, so hard question. So yes, I agree with you completely. Excessive focus on income is what got us into trouble. I think the lessons from the pandemic for the property sector in general is that you need to do proper risk management. If you cannot retain income sort of as the ordinary course of business, you need to be more conservative with your balance sheet as sort of the default position. So sort of retained earnings is how companies invest for the future and mitigate risks when unexpected things happen. If you don't retain earnings, it is better to have a safer balance sheet. So I think the lesson for all of us is to be really more focused on the balance sheets, have lower risk balance sheets. And as you say, focus on operations, not on financial engineering as a way to add value to shareholders.
Andrew, there has been a critique of the sector that it was driven largely off of the back of financial engineering and there wasn't enough focus on the property fundamentals. What do you say are the big lessons from the pandemic?
I think REITs are a vehicle that are a conduit for rental, and the job of a REIT is to optimize its net rental and pass it through to shareholders. When there are forms of financial engineering that boost your payout, but in a way that isn't enduring, then that ultimately creates problems. So we did have an extreme focus on dividends and on growth in dividends, and that drove financial engineering. It wasn't all that the strategic decision making around property was wrong. In fact, very often the property portfolios are well managed and the property strategies are sound. But when you factor into a REIT structure artificial engineerings that increase distributions, obviously sometimes at the expense of balance sheet risk, that's the real factor. And you know, I don't think a lot of the REITs have got it very right. The weakness in share pricing has been impacted by many factors, not all of which have to do with the internal financial health of the REITs.
I suppose the issue, Andrew, is if the REITs got it so right, why were they asking for an exemption from their REIT status to withhold declarations and dividends in order to support their balance sheets through the crisis? But Malcolm, I want to come to you to get your opinion on the big lessons learned through the pandemic for property owners.
Look, I think one of the big lessons were, and I think it started to be learned before the pandemic, was correct valuation of properties. And I think that was fundamentally the maturing of the valuation industry and how to value properties regularly in a sustained basis and independently. And I think once that fundamental element of the REIT sector has bedded down, which it has now, and I think you've got a correct reflection of values, you'll find that the base has been reset, and I agree with Andrew 100%. If you go into many of the REIT structures, the actual property fundamentals are managed very well. So it's not a property per se on the ground problem. It is more a macro problem where you might see the economy not performing the way it should be, and thus you're seeing the net income not actually being produced that was projected in a lot of the REITs.
Madeleine, I want to come back to you. What do you make of the fact that so many local REITs have passed the solvency test quite clearly and the liquidity test so far, but they're not paying out their distributions, and yet they retain their REIT status?
Yeah, I mean, I can't comment on that. Unfortunately, the REIT status, that's the regulatory regime. The idea behind the REIT status was, as Andrew said, as a conduit for net operating income. Fundamentally, as a shareholder, I actually think that the board should come to shareholders and say, it is up to you to decide what this capital structure should be. Do you want to put in equity and de-gear the balance sheet? To forego the distributions and pay the taxes on what is retained, I think is the least efficient way of de-gearing the balance sheets. Yes, I know that these companies trade ostensibly at discounts to NAV, and management is reluctant to issue at these large discounts. I think that's a complete red herring. I know that that's not a widely shared view. But to pick up on a point of Malcolm's and Andrew's, South African property might be managed quite well by the management teams, but it is a really tough operating environment. You're not seeing any growth in rental income. You're seeing pressure continuously on the margins in these businesses, and we continue to see really tough conditions on service delivery and municipal effectiveness. And so I think these businesses going forward face structural problems, one of which would be very helpful to address would be substantially lower gearing in these businesses, to give flexibility for more operational focus and less concern about the sort of guaranteed payments you have to make to your debt providers. So I think longer term, I know I'm not answering the question you asked about maintaining REIT status, but I think lower gearing is fundamental to the solution of this property sector.
I mean, it's really a question for the JSE to answer as well. But Andrew, what is your thought on that? Because it is a question that's continually asked in the market. The fact that the structure is a regulated structure, and that you've got this special tax status and dispensation, but in order for that you've got to be paying over this regular income to shareholders. It's why they invested in the structure in the first place. And by all means say you want to rebuild your balance sheet and change your REIT status, but then pay back the tax and be upfront with shareholders about it. What are your thoughts?
So Michael, there aren't any REITs that have been sufficiently solvent and liquid to pay a distribution that haven't done so. So the question about maintaining REIT status despite not paying distributions is not a question that's been tested as yet. You have, to my knowledge, 2 REITs that have said we're perfectly solvent, but our liquidity is such that we are not paying a dividend in respect of a particular period. And that then doesn't infringe any REIT principles, because the obligation to pay out as a REIT is an obligation to pay out 75% of your distributable earnings if you are solvent and liquid enough to do so. So as yet, the principle of what does it take to lose your REIT status involuntarily, that principle hasn't been tested yet. And the JSE has been pretty firm on its view that intrinsic to the REIT is an obligation to pay out your distributable earnings in cash. So I don't think that this is any kind of regulatory uncertainty. I think that there is a business model question where you have property owning companies that say the best that we can do for shareholders may be to stop being a REIT for a while, so keep our profits, plow it back into the business, particularly if you have, for example, a big land bank or you've got developments on the way or whatever it is. There may be very good commercial reasons to say we are going to voluntarily surrender our REIT dispensation at least for a period while we make more value for shareholders. And I think we will see some of that in the next 12 months.
And just to say on another point that Madeleine raised around bolstering the balance sheet through distributing or issuing scrip, it hasn't really been a hugely popular option. We've seen some large REITs do it, though, because of the deep discount that many point to the net asset value. What do you make of that strategy to shore up the balance sheet?
Yeah, I as an old corporate financier, I think it's corporate finance 101 that you don't issue shares when they are discounted to your underlying intrinsic value, and you aim to issue shares when the share price is at a premium to your intrinsic value. So for me, that's a basic principle. If you are issuing shares on some kind of rights issue type basis, and a dividend reinvestment program would be an example of that. So if there's a pro rata right to follow your rights, translate what would be a cash receipt into a discounted share reinvestment, I can see the arguments both ways. I still think that in the long run, if you're creating value for shareholders, you should always avoid issuing shares at a discount, whether it's pursuant to a DRIP or a rights offer or on any other basis. But I get the logic. The logic is it's neutral, bolster your balance sheet and get on with it. I would say that there were expectations at the commencement of the COVID pandemic and the lockdowns. There was a great degree of uncertainty. You hadn't seen REITs not getting in the rental previously. So in face of all that uncertainty, there was a lot of expectation that you might see distressed rights issues, forced equity raisings. You've seen very little of that. So REITs have operated through very, very difficult times, and they've come through, and most of them are actually in pretty good shape. So despite the kind of the expectations of distress and perhaps the very, very strong uncertainties that everybody faced in the second quarter of last year, I think REITs have come through in good health.
We'll come back, and Malcolm, exactly. I wanted to bring you in just to get your thoughts on this particular issue before we go to a break, and then kick the bricks and find out from you what's going on operationally on the ground.
Yeah, I could just echo that because, I mean, I think during that COVID hard lockdown period, if you look at how the REIT stepped up, how they supported the retailers or the office tenants to get through that period of time, it was a huge cost to them. Income dried up. And if I have a look at where we've come from in that period to where we are now, just before this, the announcement of the lockdown the night before last, I mean, we saw rental recoveries, arrears collections up, vacancies were starting to be stabilized, arrears were stabilizing as well. So I think there's been a lot of progress in the REIT sector as far as management on the ground is concerned, and that gave us a lot of hope that the worst was behind us, and obviously we have a new challenge that lies ahead of us.
And we'll come back to that after the break. We're kicking the bricks in REIT land, which has been remarkably resilient. It's come back quite strongly to be one of the best performing asset classes this year. Some people questioning whether it's too much too soon. We'll go and kick the bricks after the break.
We were there when no other newspaper dared print on a